Yeah, well, I think that's part of this transition that we're experiencing now. The global community is beginning to embrace the fact that gold and silver are money. It's a currency, and they're moving away from the idea that this is a commodity. And certainly with silver, because silver is actually an industrial, has many industrial uses, and it was penalized for a long time as being just another commodity like lead, zinc, copper, and silver. And so it kind of traded and was sensitive to the economy and the business cycle. But now, as people understand that it's divorced from the business cycle, it's divorced from the economy, it is money, and therefore it is going to rise as a function of the collapse of the fiat money empires around the world and cartels. That's another huge transition point that brings in a huge transitionary influx of capital that moves into this, again, teeny market. Remember, the entire silver market, the above ground stock of silver is only 30 billion. Oh, now it's higher, of course. Now it's only $40 billion are available in silver. I mean, to put that into perspective, that's still less than what Goldman Sachs think the valuation of Facebook is. They think Facebook's worth $50 billion, a company that with no barriers to entry, that was been in existence for less than 5 years. No one's seen their financials. Has been offered to insiders in a corrupt, illegal way, according to the SEC, Goldman Sachs, who there's no press, there's no visibility in terms of even if the company is going to be around in 5 years. This is worth $50 billion. What's all the silver in the world? That's the billion ounces that exist in the world today. What's the total valuation of that? It's less, $40 billion.
Well, that's what Wall Street bonuses were last year, was $40 billion.
Right, and that's just picking 1 or 2% in fees from the $700 trillion in derivatives that were traded. So as the fiat money and the derivatives and the $4 trillion per day Forex market continues to collapse, if only 1 or 2 or 3% of that collapsing building of fiat demolition finds its way into silver, that means that instead of being a 30 or 40 billion dollar market, it becomes a $100 billion market. And of course, that means you're talking about $80 to $120 to $150 per ounce silver, which is, I think, without a shadow of a doubt now within striking range as we get into phase 2 of the bull market for silver.
But speaking of currencies, you were also talking about, the risk of owning any share in any company is management risk, that you could have an incompetent manager or you could have a corrupt manager. And you also have that risk of dilution where they print up new shares willy-nilly and start giving them to insiders and friends. But that's the same thing that appears to be going on in the global currency markets, the global central banking market. You have a lot of printing up of new units of currency to hand to insiders for free. And we seem to be in that spiral, and that's part of the reason why gold and silver are acting as currencies and soaring in price, because people are starting to doubt the management of the fiat currency system. They look around them and they see either incompetent or corrupt managers, CEOs of these currencies, and they're seeing major dilution going on.
Yeah, well, for decades, people with money, with wealth management, and let's say cash managers on the balance sheets of huge corporations with hundreds of billions or even trillions of cash to manage, you could get 5, 6, 7% on your cash. In a government-backed money market, you could get 5% on 2-year Treasury notes in a AAA rated country, and 5% on $100 billion is a nice return, riskless. And then you could enhance that return by going in there into the derivatives market or the options market and putting on various spreads, et cetera. But since 9/11 in particular, when interest rates were dropped down to under 1%, we haven't seen, the trend for interest rates is down. In Japan, it's been under 0.5% for couple of decades, in the U.S. and around the world, interest rates are, at that 0% level. And so the argument that, we're going to end up going back to an environment of 5%, 6% returns on cash, it's just not materializing for a number of different reasons. Look at the U.S., for example. The reason why Bernanke flooded the economy with trillions in fresh fiat credit is to stimulate the real estate market that had crashed starting in 2007. Well, what's this current state of real estate? What's the current state after quantitative easing round 1, quantitative easing round 2? How's the real estate market doing? The target that Bernanke was looking to stimulate and to reflate. Well, according to Business Insider, there are 10 real estate markets in America right now that are at the lowest ebb of their entire move down and are on the edge of falling into a complete, utter abyss. Heading the list is the Miami-Dade County area. Prices down there, 30, 40% off the top, 50% off the top. They're talking about prices dropping 50% from here, 60% from here. Vegas, parts of California, Illinois. So the real estate market in the U.S. is at the lowest point of the entire down cycle and about to really crash seriously at the moment. So that was a total failure by Bernanke. This is a total black hole, a vortex imploding of debt. And so this money printing operation has got to continue. Interest rates are not going to go up anytime soon for the next 10 or 15 or 20 years. It's impossible. So therefore, these people who have tons and tons of cash to manage, the idea that they're going to get any return on their cash from returns on any of these sovereign bonds is dead in the water. It's not going to happen, except for a few countries which are resource-rich countries with mining and oil. So that brings you to, of course, Australia, New Zealand, Canada. These countries are currencies are trading up against the dollar. And Brazil, they've got interest rates that are backed by, they've got some higher interest rates. But then you've got the currency risk, of course, which is the word risk is something you're trying to avoid. When you had the world reserve currency and it was paying 5%, you could get 5% without any risk. And this was the situation for decades. Now it's completely gone. The world reserve status is done. But having said that, let's look at Australia and Canada for a second. And let's look at Australia. Australia has been the darling of the currency market. It's also been, a real estate boom, which is continuing through 2007, 8, 9, 10, and 11. It had a downtick a couple of years ago. The government came in. They offered a lot of stimulus to keep it floating. And as a result, the market's been strong. But people like Steve Keen in Australia who've been predicting real estate collapse in Australia, they have been on hold waiting to see if a collapse materializes, which would be in line with the global deflationary collapse. It looks, Stacey, as if real estate market in Australia is, in fact, now entering a massive downturn. What do you see?
Yeah, well, they were reporting that in Queensland seems to be leading the way, that they're having price declines of up to 40% in some regions. And remember, this is like the Alberta of Canada, Alberta of Australia, and that it's the intense. This is where all the mining and all of the cotton and a lot of the agriculture, a lot of all these during this commodities boom, this is the area that has benefited the most. So this could be like Dr. Copper, in that even at this location, which is benefiting so much from the commodity boom, you're starting to see this collapse. But also, it's a tourist-rich area, so a lot of the tourist zones, those cities and areas, that's the housing market sector that's starting to collapse. And it's also where the extreme weather has been hitting. You witnessed all of the massive historic floods in that region in the last few months. So yes, this seems to be the beginning. The vortex is happening in Queensland, and then should spread to the other cities in Australia. But we're going to be speaking to Steve Keen actually very soon. He's coming through Paris, and we're going to talk to him about this and get an update on it.
Right. So people who are parking their cash in Australian dollars, you've got this currency risk because the government now, as the economy deflates and as the real estate market deflates, they will start to bring interest rates down, and this will bring the currency down in value. And this is same thing goes across anything priced in Australian dollars. So that appears to now be turning a long delayed turn in that market. Canada, the thing about Canada is that they still do most of their trade with the U.S. and the U.S. is shrinking. So that's a negative. On the positive, they've got the tar sands, they've got Alberta, they've got energy resources. So people buy, it's a proxy for oil in a lot of ways, and oil is up, and oil will continue to go higher. So Canada's got that going for it, you could say, as a commodity-based currency.
Yeah, but I want to say before you move on, there is that Canada. I think that could be popped as well, because I don't think people are taking into account what the U.S. own naval assessment, I think it was in 2003. The U.S. military sees possible conflict with Canada coming up as the Arctic ice sheets melt and the Northwest Passage becomes navigable. Right now, America has allowed that to be Canadian territory, but I think they've made it quite clear that once that the Northwest Passage is easily navigable, the U.S. wants to control it, and they are sending out signals that Canada better not think that they have the right to control that region.
Could be. Then we got the UK pound. UK pound has been relatively strong in the last year or so. Going forward, this coalition government and the imposition of the austerity measures, it seems like it's heading for a big conflict. And inflation is just eating up this economy alive. Price of gas in the UK has never been higher in the entire country's history. Food prices are escalating. How is the government going to deal with this? They need to print more money, which is going to debase the British pound. What is it has very little manufacturing left. The country is now an energy importer. It used to be an exporter with the North Sea oil, now basically having hit peak oil in the North Sea. They're importing their oil and energy. So they're really become like Japan in that sense. They don't have their own energy enough to supply this economy. Their primary industry is banking and hedge funds.
But that's exactly why I think there's so much support in, say, that audience at 10 o'clock live for bankers, is because, they might be criminals, but that's where a lot of British people receive their livelihoods, they believe. They think it's the bankers and the dictators and the oligarchs having free reign here. Look, every oligarch, every dictator being chased out of the Middle East comes to London. All of their billions are found in banks in London. And that plays a lot on the psyche of the population here. They know that's where their butter for their bread comes from. They know who's feeding them. And I think that, they don't realize that they could have a better economy if they let these bankers and dictators not receive safe haven and, from looting their own countries and economies and financial systems.
Well, they don't make the connection between rising energy and food prices and the corruption in the city.
Yeah.
And they're told on their major media outlets only one side of the story, that the third of the country's revenues come from banking, and that the third of the country's tax collection comes from banking. Well, that's true. And 80 to 90% of the reason why food and energy prices are now so high is because of the bankers. If you got rid of the bankers, you would lose tax revenue, but you would gain from the purchasing power